I want to start with something that Ray Dalio and his elite macro strategy team sent to their wealthiest clients this week. Not to retail, not to you, not to me, but to the hedge funds and institutional money managers who pay $50,000 a year for access to their private research notes. This confidential intelligence briefing outlines a brutal mathematical certainty regarding the escalating United States and Iran conflict. Right now, the mainstream media is flooding your screens with panic, showing you images of missile strikes, blocked shipping lanes, and political chaos. They are telling you to sell everything, to hoard cash, and to prepare for a devastating global depression. But behind closed doors, the smart money is not panicking. They are executing a highly calculated playbook designed to extract generational wealth from this exact geopolitical crisis. Let me be direct. The retail market is currently frozen by fear, paralyzed by the daily barrage of terrifying headlines. Meanwhile, institutional titans are quietly positioning themselves for what Ray Dalio identifies as the inevitable policy panic. This is a structural mechanism that has occurred during every major geopolitical shock of the last century, and if you understand how it works, you can position your portfolio to capture explosive upside while the rest of the world is panic selling at the absolute bottom. Before I break down the exact sectors and the specific rules you must follow to survive and profit from this event, you need to understand the bleak present reality of the markets. Over the last 72 hours, we have seen a violent repricing across all major asset classes. The S&P 500 has dropped sharply as algorithms indiscriminately dump equities. West Texas Intermediate crude oil has spiked past critical resistance levels, threatening to reignite the very inflation the Federal Reserve has spent the last 2 years desperately trying to crush. Bond yields are surging, flashing warning signs of a severe liquidity crisis, and consumer sentiment has plummeted to levels not seen since the dark days of the 2008 financial collapse. Retail investors are being margin called, their portfolios decimated by the sudden spike in the VIX. The fear is palpable, and it is entirely justified if you are operating blindly. But this is exactly where the convergence of structural impairment and temporary sentiment repricing creates the ultimate opportunity. The institutions know that a U.S. and Iran war is not just a regional conflict. It is a global energy shock that forces the hand of central banks. When oil prices skyrocket, the initial market reaction is terror over runaway inflation. But the smart money looks past the first derivative. They know that a massive spike in energy costs acts as a catastrophic tax on the global consumer. It destroys demand. It halts economic growth in its tracks. And this brings us to the core mechanism of the wealth transfer, the macroeconomic shift from inflation fears to recession fears. When the economic data begins to reflect this catastrophic demand destruction, the Federal Reserve and central banks worldwide will be forced into a decisive policy panic. They will have to abandon their inflation fight and pivot aggressively to save the financial system from a deflationary freefall. This pivot is the hidden mechanism. It is the moment when quantitative easing returns, when liquidity is injected back into the system, and when the assets that have been beaten down the hardest experience a violent parabolic melt-up. Subscribe now. You need to understand what triggers this reversal. There are 3 specific events, 3 triggers that will ignite this massive market rally, and you must watch for them like a hawk. The first trigger is the whisper of de-escalation. I am not talking about a peace treaty. I am talking about back-channel diplomatic chatter, a subtle shift in rhetoric from either Washington or Tehran that suggests the worst-case scenario of a total regional war might be avoided. The market is a forward-looking mechanism, and it will price in peace long before the missiles stop flying. The second trigger is direct Federal Reserve intervention. Watch the bond market. When the credit markets begin to freeze and corporate debt issuance grinds to a halt, the Fed will step in. They will announce an emergency facility, a pause in quantitative tightening, or a surprise rate cut to stabilize the system. The moment that happens, the bottom is in. The third trigger is decisive executive action regarding domestic energy production. If the U.S. government announces emergency measures to flood the market with strategic petroleum reserves or incentivizes massive new drilling projects, the speculative premium on oil will collapse, removing the suffocating pressure on the broader equities market. Now, let me tell you exactly where Bank of America and the smartest macro funds are placing their bets. There is a four-part sector playbook you must follow. Sector 1 is energy infrastructure. I am not talking about speculative exploration companies. I am talking about the pipelines, the liquefied natural gas export terminals, and the midstream operators that possess hard assets and long-term fixed-rate contracts. These companies are generating massive free cash flow. They are insulated from the immediate volatility of the commodity price, and they are critical to national security as the global supply chain reroutes away from the Middle East. Sector 2 is defense and aerospace. This is the most obvious play, but the retail market chronically misprices the duration of the CapEx cycle. A conflict with Iran guarantees a massive multi-year increase in global defense budgets. European nations, Asian allies, and the United States will be forced to replenish depleted munitions stockpiles and invest heavily in next-generation electronic warfare and missile defense systems. The backlog for these prime contractors is about to swell to record highs, guaranteeing predictable revenue for the next decade. Sector 3 is the counterintuitive reveal, consumer discretionary. Right now, this sector is experiencing peak pessimism. Retail investors are dumping these stocks because they believe a recession is imminent and consumers will stop spending. But the smart money is buying. They are buying because they know that when the Fed pivots and initiates the policy panic, the consumer discretionary sector is mathematically the most sensitive to falling interest rates. The companies with strong balance sheets that survive the initial shock will see their multiples expand violently as liquidity floods back into the system. Sector 4 encompasses high-margin software and financial infrastructure. These are the companies that form the digital backbone of the global economy. They have been dragged down by the broader market panic, but their underlying cash flows remain completely intact. When the fear subsides, capital will aggressively rotate back into these high-quality, wide-moat businesses that offer secular growth regardless of the geopolitical environment. To execute this playbook, you need an analytical framework. You must learn to separate structural impairment from temporary sentiment repricing. Structural impairment means a company's fundamental business model has been permanently destroyed by the conflict. Sentiment repricing means the stock has crashed simply because of blind algorithmic selling and retail panic, while the core business remains highly profitable. You only buy the latter. And to ensure you do not get wiped out before the pivot happens, you must follow 3 unbreakable rules for survival. Rule 1. Remove all emotion from your decision-making process. The headlines are designed to terrify you. The volatility is designed to shake you out of your positions. You must operate with the cold, calculating precision of a machine. If a stock hits your fundamental buy target, you execute the trade. You do not wait for the news to sound better, because by the time the news sounds good, the institutional money has already front-run the move and the opportunity is gone. Rule 2. Never use leverage during a geopolitical shock. The violent intraday swings will trigger margin calls and force you to liquidate your positions at the exact worst possible moment. You must survive the drawdown to participate in the rally. Cash is your buffer and patience is your weapon. Rule 3. Scale into your positions systematically. Do not try to catch the exact bottom. The market will likely test new lows before the final capitulation occurs. Divide your capital into tranches and deploy it incrementally as the RSI reaches extreme oversold levels. Let me close with the historical proof, because pattern recognition is the ultimate edge in financial markets. If you look back at every major global oil shock and geopolitical crisis since 1973, a distinct pattern emerges. In 1973, during the Yom Kippur War and the Arab oil embargo, The market crashed, inflation spiked, and retail investors lost everything. But the smart money bought the panic, and within 2 years they doubled their wealth. In 1979, during the Iranian Revolution, the exact same mechanism played out. In 1991, during the Gulf War, the market anticipated an apocalyptic disruption to global energy supplies. The S&P plummeted. But the moment the ground war began and the uncertainty was removed, the market launched into a massive multi-year bull run. We saw it again in 2001, and we saw the ultimate policy panic during the 2008 financial crisis. Every single time, the sequence is identical. The crisis hits, the retail market panics, the smart money accumulates heavily discounted assets, the central banks intervene, and generational wealth is created for those who were positioned correctly. We are standing at the precipice of the next great wealth transfer. The U.S. and Iran conflict is the catalyst, but the central bank reaction is the true driver of the upcoming rally. The window of opportunity is rapidly closing. The institutional money is already making their moves. They are quietly accumulating the exact sectors I just broke down for you, and they are waiting for the policy panic to ignite the rocket ship. You can choose to remain paralyzed by fear, glued to the terrifying headlines, and watch as your purchasing power is eroded by inflation and missed opportunities. Or you can act like the smart money. You can use this crisis to your advantage. You can follow the framework, adhere to the rules, and position your portfolio for the inevitable macroeconomic pivot. Remember, confirmation always comes after the move. If you wait for the skies to clear, if you wait for the Federal Reserve to officially announce the end of the crisis, you will be buying at the top. You will be providing exit liquidity for the hedge funds who bought the blood in the streets. Stop waiting for certainty. Certainty is an illusion sold to the retail public to keep them docile. Act now, position logically, and prepare for the massive wealth generation that is about to unfold. The geopolitical landscape is fraught with engineered panic, but those who understand the mechanical flow of global liquidity will never be victims of circumstance. You must recognize that the wealth transfer is not a chaotic accident. It is a highly structured mathematical process that rewards the prepared and punishes the emotional. Ray Dalio and the elite institutions understand that the true risk is not the temporary drawdown of high-quality assets, but the catastrophic failure to deploy capital when the market is offering historic discounts. When the dust settles on this conflict, the disparity between the smart money and the retail public will be wider than ever before. The institutions will have locked in dividend yields and cost bases that guarantee immense prosperity for decades, while the average investor will be left trying to rebuild a shattered portfolio from cash that has been deeply devalued by the central bank interventions designed to save the system. This is your moment of absolute clarity. You have the intelligence, you have the historical precedent, and you have the exact sector playbook required to navigate this storm. The U.S. and Iran crisis is merely the ignition switch for the next great cycle of structural wealth creation. Do not let this generational opportunity slip through your fingers because of manufactured fear. Take decisive action today, trust the macroeconomic framework, and step confidently into the ranks of the wealthy.